W-2 employees get on taxes. Here's how to yourself. The problem is when you're a W-2 employee, you actually have only standard deductions that you have access to. By intention, you are the backbone for the IRS to collect tax dollars on. So by intention, you have a limited amount of deductions that you are able to take. They're called standard deductions, all right? So we're gonna put SDs here, standard deductions. Unfortunately for you, there's only so many deductions that you can get to write off your earned income and give less to the IRS, okay? Today, we're gonna talk about deductions that you can take, and I'm gonna walk all over the Roth, okay? Because the Roth is dumb. I'm gonna walk all over the Roth, show you what you can do to multiply your money, pay less taxes, break into asset classes that normally only accredited investors can get into, that have high cash flow, allow you to write off up to 100% of the investment against your earned income, and be able to have large exits and build wealth, all in this video, okay? So recap real quick, who the heck is this for? If you are a W-2 employee, if you are a 1099 contractor, this video is for you. And some of the assets that I'm gonna be getting into as well qualify for anybody that owns a business as well. The reason that I wanna focus on W-2 employees and 1099s is because you guys get the most when it comes to taxes, and you need to learn the write-offs that you can take to pay less taxes and the investments that you can take to create more cash flow and build more wealth. So one day you can say, my job, I quit because I have enough passive income, all right? If you're brand new to my channel, smash that like button. If you're already offended, you can leave. And if you wanna know more about financial education and building real wealth outside of the modern financial system, like a true capitalist, you're in the right place. Make sure to subscribe. So the first thing is, I'm just gonna use like a random number of $100,000, okay? The average millennial with a 4-year bachelor's degree makes $80,000 a year. If you got like 9 degrees because somehow people think that makes you make more money, maybe you make $100,000 a year, okay? So one of the first things people do is they're like, oh my gosh, the employer I work with has great benefits because they do the employer match and they contribute to my 401 or my Roth, and that makes me feel all warm and fuzzy, and they've got good insurance and a good dental plan, so like that's why I work there, okay? And then you chase a 50-cent raise every 6 years, and by the time you retire, you don't have money. Roth IRAs, these are attractive to people because an advisor will say, well, pay the taxes now, and then you don't have to pay the taxes later because you get tax-free wealth. Yeah, but you gotta lock it away till you're 59 and a half, so that's also stupid. Okay, so with a Roth IRA, this is very common for people to take. And it's okay. You're not getting a deduction on your income here, but you're investing tax-free. The reason I bring up a Roth IRA is because rather than doing the Roth, why not an HSA? A health savings account. Now, real quick, do not use the health savings account for health and medical expenses. Don't use it for expenses. Use it as an investment vehicle. Why would I say that? So you can invest presently into a health savings account, $4,300 a year if you're single. If you're married filing joint, it's $8,550 a year, okay? Instead of using this for medical expenses, you use it to do a lot better than you'll do in a Roth. And here's the reason why. In a Roth, sure, you can invest a little bit more. And sure, your employer will give you a little bit of a match, okay? But with a health savings account, you're getting the deduction against your earned income here. So $4,300 allows you to write off all of that. So your tax basis is gonna be $95,700, right? So you're able to get that. Save a few hundred, maybe $1,000 on taxes. Okay, so there's a win. $95,700 lowered my tax basis too, okay? But now we can invest tax-free. Any of the growth in the HSA is tax-free, okay? So the second caveat to an HSA is you want to self-direct, right? You want to self-direct so that you can go into assets that historically outperform the market. I go into real estate assets that do double return every 5 years or better, okay? Present deal that I have is projected to be a little bit higher than a 20% internal rate of return, all right? For those of you that don't know how IRR works, if I have a 14.4% IRR, it means I'm doubling my money every 5 years. So the fact that I can go into an asset that is a 19, a 20% IRR means that I'm doing a lot more than doubling my money every 5 years, okay? So rather than getting 8% in a retirement account or 10%, I'm self-directing, I'm getting the tax deduction against my earned income, and I'm going into a self-directed HSA that allows me to go into real estate where I can double every few years, oil where I can do the same thing, and if I want a non-yielding hard asset that hedges inflation, I'm picking up some gold and picking up some silver, all right? And even if we look at gold and silver in the last 30 years, gold has returned 10.9% average annual return in the last 30 years. Silver, 9.3%. Okay? These numbers are much higher in the last few years because the dollar's been heavily inflated, and when the dollar's inflated, you see a lot happen with interest rates. Interest rates just dropped on the 17th of September, 25 basis points, and then what did we see? Gold, in anticipation of that, went up. When the real estate market crashed in 2008, gold went up 24% that very same year, okay? So due to economic times, inflationary periods, this 10.9% that gold is going up, or 9.3% that silver is going up, is actually much higher in recent years. From 2015 to 2025, gold has tripled in value. Silver, same thing. So if we look at the last 10 years, it's a lot higher than 10, 11, 9%, okay? And when you start understanding the assets that you invest in, rather than relying on your retard financial advisor, you can go back and forth. You can sell off. You can go back into this, you can sell this, you can go back into here, and you can start building wealth within the HSA. Now, again, if you've seen my other videos, you've also seen that I'm not interested in anything that makes me less than 25% annually. If I'm accumulating by self-directing at a 25% annual return in here, and I'm stacking and stacking and stacking and stacking, I'm outperforming the S&P. I'm outperforming what most advisors are talented enough to do. I'm not paying the fees because I'm understanding the assets myself. I'm getting the tax deduction here. I'm maxing it out. So this is a really good recommendation over your Roth, which is not getting you this deduction, okay? Now, one of the reasons I don't have a Roth myself is because I don't care to keep my money locked away till I'm 59 and a half. And if you want to access it earlier, you have to pay a 10% penalty, all right? So I want to be able to multiply, I want leverage, and I want to be able to speed up deal cycle, meaning if I invest in a real estate asset passively, I want to be in it a few years, exit, roll the money back into the next one, exit, roll the money back into the next one, okay? And you have a lot of restrictions when you're tied into a Roth, which, because you are an employee, you get the short end of the stick when it comes to the things you can do to lower your taxes and invest, which is why I want to bring up my third point. Going into an investment where you normally have to be accredited, and I'm going to explain that right here. I guess we're out of paper, so I'll write it on here. Normally, if you go into oil, you own partial interest in an oil well, an oil and gas well, you have to be accredited. There's what's called Reg A, Regulation A funds, okay? And Reg A funds allow for non-accredited investors to participate in deals where you normally would have to be accredited. So when you get into oil, why would I say oil, all right? Well, let's take you that's making $100,000 a year here, and you're a good saver because that's what we've been taught. Save, let your money rot in a savings account and save to save and never learn how to invest and die broke. That's what we've learned to do. So we have a savings account, and let's say that we've got $60,000 in there. We take that $60,000 and we invest in an oil well. When you invest in an oil well, you can get 80 to 100% write-off in the year that you invest. What does that mean? You're going to have $48,000 to $60,000 of tax deductions. It's almost like having bonus depreciation on a vehicle where you can write off 100% of the expense, except you can't because you're not a business owner. Business owners are able to do that. Okay, so if you are a W-2 employee, you can't take advantage of Section 179 bonus depreciation. But investing in an oil well is like being a W-2 employee that has access to Section 179 bonus depreciation. Instead of sending the IRS a bunch more money, you invest in oil, you write off 80 to 100% of it, and you drop your tax basis from $100,000 down to 40, 50, 60, and then you get cash flow. Now you are getting monthly checks every single month distributed directly to you. And when you get that cash flow, you have something called the depletion allowance. Here's what it means. Every dollar you get in cash flow, your tax basis is 85 cents, okay? Then you have what are called TDCs, tangible drilling costs. Typically, this makes up 20% of the cost of drilling an oil well. These are normally depreciated over a 5 to 7 year period, but because of the big beautiful bill that Trump put into place, that depreciation is now up to 100% in the first year. So you get a triple tax threat deduction, right off 80 to 100% of the investment capital against your earned income here. Accessing normally an accredited investment only through a Regulation A fund, all right? You get the depletion allowance, you get the tangible drilling costs, and when you exit, you can 1031 into the next deal. You can go into real estate back into oil. That is the game that I play. Now you might be asking, okay, Ben, who do I work with? Where do I find these deals? What type of cash flow to expect? And I also want to address the question in the room because I also get a lot of comments that are like, hey, I invested in oil, I lost my ass. I invested in it, it didn't work. You can't get these type of returns. All right, if you don't understand an investment, it is risky. If you work with somebody that is not trusted and doesn't have a track record, it is risky. If you choose not to understand the asset that you're investing in, you're an idiot. If you leave it up to somebody else that you do not understand the type of questions to ask to evaluate if they know what they're taking your money and investing in, you're an idiot. So don't be an idiot. Invest in assets that you know, that you like, and that you understand. I know, like, and understand real estate and oil. I specifically invest in areas when it comes to real estate where there's high year-over-year rent growth and appreciation. When it comes to oil, you have to understand nuances. Nuances being, what is the price of a barrel of oil? Is it $65? Is it $68? Is it $72? Is AI putting such a strain on natural gas and fossil fuels that is causing more of a demand for natural gas? Because this comes down to how much cash flow you get out of oil wells. Is the oil well vertical or horizontal? I only do horizontal because it's a lot less risky. I only work with operators that have been doing it for 4 decades, that have participated in thousands of wells. And you have to understand when you drill oil, and this is why I do all of this passively, right? Because if you're watching this, you're like, wow, this is a lot of information. I don't want to operate, I don't want to be active. Exactly. That's why I invest in real estate funds in areas that have high year-over-year rent growth with partners that manage hundreds of millions of dollars under assets. That's why I go with oil operators, one in particular that's been drilling oil for 41 years and done over 1,100 wells, okay? Participated in over 1,100 wells. And you have to look at the little nuances. When you drill oil, you get water, you get natural gas. Water is not profitable. The other two are. What's the presence of natural gas? Is it highly refinable? In other words, you can get a premium for it because it can be refined into propane, methane, gasoline, all these different gases. So you get a premium for it. What's the ratio, okay? Is it 30% natural gas, 70% oil? Is it the other way around? When you understand these things, then you understand how to create profit. What's the cash flow look like? Typically, the oil deals that I've been involved with, 11 to 23% in cash flow. Now, I also keep my money, before I invest in this, I keep my money in an area that makes me 8 to 12% internal rate of return, okay? So when I'm getting 8 to 12% IRR, and then I'm getting into real estate deals that do 19 to 20, and I'm getting into oil deals that cash flow 11 to 23% annually, it meets my 25% annually all day long, oftentimes even higher, right? Along with all the tax deductions I get. Guys, if you like this so far, please smash that like button. And if you have any questions, please drop it in the comments. I'll do my best to answer, all right? And in a second here, I'll tell you how you can also, access all of this stuff so you don't have to go alone and try to figure it all out yourself, because that took me a long time to figure out who to trust, who to work with. I made the mistakes, I spent the money, I lost my ass before I figured out, oh, here's the guy to work with here, here's the guy to work with here, here's how this needs to be structured, here's the questions I need to ask, this is the learning experience I needed to have. I put it all under one roof so that way you guys don't have to go through the same struggles that I did. So 11 to 23%, but that's just the cash flow. And how oil production works, and I'm actually gonna go to this piece right here. How oil production works, let's say I've got a well here, and a well here, and a well here. You do what's called horizontal, all right? So you typically will have a vertical well, a vertical well, a vertical well, and then they'll be connected, all right? And there'll be a pool of oil, right? That's like this, okay? And you can see why, if you are relying on one well to produce, you're only gonna pick up so much area. And these wells the deposits can be more like this, okay? They're not linear. They can be odd like that. So if you've got a well that's way over in this corner, you're not gonna get everything out of here. But when you go horizontal and you connect them, you can be all the way across that deposit, right? You see what I mean? So I go into horizontal wells, and how these will usually work is, in the first year, I'll kind of draw a graph, all right? In year 1, all right, you're gonna have production that's like this. In year 2, it usually drops down to about 60% of the first year. And then year 3, then year 4, and then it kind of levels out from there, okay? And let me draw these a little bit deeper here. These wells stay somewhat consistent for the next several years. So we're in them for 5 to 7 years typically, cash flowing. And then we take all of the ownership interest in all these different wells and you exit and you sell it to another operator in the area, like Mewburn, for example, big oil operator in the Midwest. And you sell it for a multiplier. So this whole time, you've gotten the write-off on the investment capital, you've gotten the depletion allowance on the cash flow, okay? You've gotten the IDCs, the intangible drilling costs, which are depreciated usually over 5 to 7 years, but you can do 100% in the first year. And then when you exit, you know, that's a gain that you realize you can 1031 that. A lot of people think you can only 1031 real estate. You can 1031 oil deals and you can go back into the next fund, right? There's a lot of different ways to do it, okay? If you guys have loved this so far, if you want to learn more, there's a link to a free trial to the Capitalist Network in the description. It's my insurance partners, it's our CPAs, it's the real estate funds that I'm invested in, it's the oil funds I'm invested in. It's everybody under one roof, systematized to meet you where you are at. We've got opportunities in real estate for accredited and non-accredited. You've got non-accredited and accredited oil funds, a lot of different plays in there, and for all walks of life. Whether you're trying to chip away and start building wealth with, you know, $800,000 a month, or you are a sophisticated investor and you're sitting here listening to this going, you know what, I have some moves I need to make because I want more in my pocket, I want to multiply my wealth and spend less to Uncle Sam. It's for you. Click the link in the description. Appreciate you guys, and we'll see you in the next video.